I'm Catherine Thompson, Tech Analyst at Edison, and I'm here today with Tom Cregan, CEO of EML Payments. Welcome.
Thanks, Catherine.
Could we kick off with a brief introduction to the company?
Sure. EML, we're a payment technology company listed on the Australian Stock Exchange since 2012. And in 2012, we were a one country operation, largely focusing on gift cards. And we would have had, I think we had one customer at the time and revenue of circa 3 million Aussie dollars. And we made a decision at that point to really invest heavily in our technology and branch out from purely a gift card business into other forms of prepaid commerce, which are virtual cards and reloadable cards. And we sit here today. We're in 28 countries. We're running something in the order of 3,000 programs. And our debit volume, which is one of the measures of how we would track ourselves, in 2012 was 60 million Aussie dollars and is probably in the realm of 18 billion now. So it's certainly been a big expansion over that period of time, driven by geographic expansion. Probably half the growth has been organic through the expansion of our product set, and half the growth would have been inorganic. So we've done acquisitions in the US, in the UK, in the Nordics, in Ireland. So a combination of those two things has kind of got the business to where it is.
And could you go into a bit more detail for the activities in each of your three divisions?
Prepaid is it's just part of the financial ecosystem, if you like, and typically prepaid companies are niche operators. So they're developing technology solutions for pain points within different industry verticals, and then look to monetize those industry verticals. And often those industry verticals can then be taken outside of one country and into multi-countries and into multi-regions. Again, often as they're solving those pain points, the contracts that they're entering into with their customers tend to be long-term. They tend to be anywhere from 3 to 8 years, and they tend to be exclusive. So one of the reasons that you'll see companies like us focus on certain niches is you're developing a sense of IP around that industry segment and the commercial challenges being solved. Often those challenges are the same globally, and then we monetize those, and competitors would do the same thing. So that's often what leads the kind of inorganic side of the industry, because if competitors have monetized certain niches that we think will be high growth niches in the years to come, and they've got exclusive contracts with those with their partners, then the market really isn't contestable in that sense, and so that often drives the M&A kind of activity. So in our Australian business, the kind of niches that we would focus on in the gift card space are incentive gift cards. So they are gift cards that where employers or companies would provide incentives to people for a reason. So an FMCG company could provide an incentive for someone to purchase a product, or an employer could provide an incentive to their staff, and it could be commission payments, or it could be other things like that, that they use our cards and our technology to pay them. And that we were in Australia from 2012, and we also do that across all other regions. So we do that throughout the UK, throughout Ireland, throughout Europe, and North America. In the reloadable space in Australia, gaming is a vertical that we entered into in 2014 kind of time frame. Expanded that into the UK, expanded that into other countries within Europe, have expanded that into the US, kind of over the course of that period of time. We do payroll cards, in Australia. In Europe, the biggest segments are government payments. So a lot of work with local market authorities and the UN is one of our customers. So distribution of welfare and funds to people is a large segment for us. And then one of the more recent ones through our acquisition of PFS is digital banking and a lot of work with fintech organisations that are looking to kind of disrupt that traditional banking ecosystem. And the other segment, I guess, that we would be known for are gift cards within the shopping mall industry worldwide. So we would have been the largest provider to that segment. Not in Australia, but in every other market that we were in. So that was a pretty sizable part of the business as well. So the key is certainly, you never stop investing in technology. You never stop investing in the solutions, but then building those solutions. And one customer doesn't make a segment or a niche, but one customer, two customers, three customers, and when you've got 10 in there or 20 in there, then you really start to think, okay, we've got a position in this niche that we can expand and take globally.
The business has grown via acquisition over the last 5 years, and the recent acquisition of PFS was your largest to date. Could you explain the rationale for the PFS deal and how you expect it to reshape the business?
Yeah, it certainly was the largest we had undertaken in terms of the expense of the acquisition itself and the integration of the business, given it has 190 odd staff. So it certainly increased our kind of FTE levels pretty substantially. What we were looking for in that business, if I went back to April last year to when that started, we had done the acquisitions we'd done before that were largely gift card companies, and the reason we'd bought those, we bought one, I said, in the Nordics, we'd bought one in the UK, we'd bought one in Ireland, and we'd bought one in the US. And the reason we'd bought those businesses is that they were lower growth, but they were very stable businesses. So again, 4 or 5 year agreements with the likes of the Westfield Group and in Europe and other large real estate trusts, property trusts. So there was a lot of comfort for us with I think with the investment community that they were relatively low risk acquisitions. They had long-term contracts. They had limited kind of concentration, revenue concentration risk. And then to that, if you like, we added our technology on the reloadable and the virtual space. So we were buying a footprint, if you want to think of it in that sense, a market presence and a footprint. And then we kind of accelerated the growth by adding additional products into it. But as of last April, gift cards and revenue out of gift cards would have been 60, 70, probably 70% of the of the business, which isn't where we wanted that to be long term. We had always had a goal for the majority of revenues to be driven by reloadable products as opposed to gift card products. And we'd spent a lot of time looking at different acquisitions. We were certainly building that part of our business organically anyway, but we were looking to fast track that that transition. And we'd met PFS over the years at various investor events and different trade show events. And so when that opportunity came up, and given we look at we would have looked at 30 companies probably last year from an M&A perspective. Most have something missing, right? They might have really good technology, but they're burning cash and there's and have limited revenues. Some might be the opposite. Some might be printing cash, but it's just luck, and they've actually got pretty average, underlying technology. There's always something there that kind of doesn't gel. But PFS was one of those rare cases where it had grown organically over 10 years. It had done roughly £3 billion worth of debit volume, so sizable and scalable, multi-country, had verticals that we weren't in, so including government payments and welfare, and then digital banking and travel cards. So they were just different verticals that we didn't have a presence in. And what it meant once that transaction closed, was that in the month of April. Now April was a bit strange because obviously COVID was in play at that point, but it meant that our about 55% of our revenues became reloadable. So it almost flipped it on its head from 70% being gift cards, to 55-60% being reloadable. So that was the kind of genesis of that, of that deal a year ago. And as time goes on, it looks like a wiser deal, because we restructured the terms of that deal. And so what was originally going to see us with 160 million of debt, we ended up with no debt and 125 million in cash. So it meant that we ended up with the same asset and the same growth upside from that business, but with a fundamentally different balance sheet, which is a good thing to have right now in this kind of COVID climate.
Following on from that, how has the business been affected by COVID-19?
It's been, I think every payment business has been impacted by COVID to some degree, right? I mean, if we looked at payment companies that are in the travel industry that specialise in travel, they'll be down 95%. Which would correlate to just less travel happening around the world, which is obvious. And others that are, so there are a couple of organisations in the US, for example, that are in the prepaid space, but servicing, depending where you are, could be called different things: gig economy, workers, or pay for service workers. But in the US, there's a couple of companies servicing that home delivery market. Like the Deliveroos, the Grubhubs, the DoorDashers, these kind of food to your door type companies. And COVID has been a rocket ship for those companies' growth, because no one's eating out and they're all eating in. So you've got, within the payments world and the prepaid world, you've got sectors that if you're aligned to, you're winning, and you've got sectors, if you're aligned to, that you're losing, depending on how that shakes out. Within PFS, they're about 45% roughly of their revenues were banking as a service type products, digital banks and fintech companies that are kind of disrupting that banking space. In April and May, their volumes were down because people were in lockdown. So in France and Germany and Spain is a big market for us. So when no one's leaving their home, they're just transacting less, and they're transacting less across every account, right? So whether it be a neobank or your traditional bank, if you're not out and about, then you're not transacting as much. So that the volumes in that segment came down. The volumes in their government and welfare payments went up. So you've got a kind of a hedge in there, if you like, of where one is down, the other was up. 9% roughly of their revenues came from multi-currency travel cards. That won't come back, I would think, for probably 12 months at least, until there's a pickup in travel. But almost by the end of May and certainly into June, their volumes are pretty much back to where they were in March. And I think the difference between them and ourselves, which is another one of the reasons that it was beneficial to do that transaction, is that their products, if you like, are less kind of consumer discretionary. So, in other words, if I'm an individual in Spain who's using one of our partners, as their kind of primary banking tool, that's non-discretionary. I might use it less during a COVID lockdown, but once the COVID lockdown ceases, then that's still my primary kind of transaction tool, and volumes go back up. In welfare distribution and government payments distribution, again, it's not discretionary. You've got governments and a lot of agencies providing assistance to all manner of people around the world, helping them financially, during this crisis. And obviously the amount of money being spent that way is increased, which makes sense. So you've got, again, you've kind of got that, it's non-discretionary. There are money that people are relying on, and once they receive it, then they're spending that. The multi-currency travel cards, would be discretionary. So you only need those things really if you're traveling, and so if you're not traveling, then you're not using them. On the EML side of the ledger, the gift card mall piece for us, so the retail gift cards, are consumer discretionary items. So they're impacted by structural things like, are the malls physically open? If they're open, what's happening with customer traffic levels because of social distancing and other concerns. So that part of the EML business taken a hit certainly in April, May, and June, and probably may take a few years actually to get back to to where it was. And then the rest of our business again would kind of be non-discretionary, which are things like the fintech space, the kind of buy now, pay later space, the digital banking space, the payroll space. So there's a hedge there, but probably more of our business, more of the old EML, if you like, was when it was a gift card business, and again within that, a large reliance on malls. It had a large part of its revenue, which was consumer discretionary item, and so having PFS in there, not only kind of meant that more than half of our revenue came from GPR, it also meant that more of our revenue became derived from non-discretionary items, and that's only a good thing from a budgeting, forecasting, earnings, reliability, predictability, those type of things.
So what's your strategy in the short term while COVID-19 is still causing disruption, and then in the longer term when the global economy reverts to more normal activity?
Well, certainly in the short term, I don't think we've ever, and I've heard this comment, from other companies in the industry as well. But from our perspective, we've never seen so much work. In terms of, I think COVID has been an incredible shock to the economy. That's an understatement. But what it has done is really forced companies to compress long lead times for projects into months. So companies that would have been looking at a risk or a pain point and saying, I think we need to address that. We can get to that in the next 12 to 24 months. Well, that 12 to 24 months is now 3 months. So the amount of workflow and opportunities that are kind of coming our way across all the regions is the best it's ever been. So for us, in that sense, COVID has been we'll be a beneficiary of that. Now, all of those programs that we sign and we launch, take time to build, and obviously as they build, the revenue we get from them build. So when we're launching programs on day one, there's not a pot of gold behind every program. It's an aggregate of those programs that we launch, and then over time, as those programs build, then our revenue builds, and that will, so that's been a really positive thing, for us in the last 90 days, and we don't see that stopping anytime soon. Our strategy is to almost double down on that. So we're being in the position of having 125 million in cash. We're looking at ways that we can invest that wisely to kind of accelerate that. We're going to be looking at, whereas other companies might be having to kind of reduce costs and furlough workers and so forth. We're able to just focus on the on the growth side of our business, which will absolutely be in the fintech space. So our purpose in going forward is internally is to really help shape digital transformational change for companies. So the companies that we'll be working with and partnering with are companies that are disrupting part of the fintech chain, and it could be across the board. So neobanks and across Europe are obviously disrupting traditional banking. So we'll be partnering with those companies. We do that now, but we'll be aiming to do that in bigger quantities. Crypto, we already partner with a number of crypto exchanges that enable people to access their money. Crypto is by definition disruptive, so we'll be looking to do more of that. We signed deals recently with companies looking to use our cards to pay out insurance payments to people, direct into a wallet on their phone. So again, insurance payments have always been relatively staid in terms of how that's been paid to individuals, and you've got companies now looking to disrupt that. You've got companies, even in the payroll world, looking to disrupt how we get paid. So what is common now in the kind of gig economy space of workers being paid by the job, we think that all professional workers really, over time will start to get paid in a more flexible way, rather than just at the end of the month, because that suits the payroll department. And there are numerous companies out there around the world looking at disrupting that, and we're looking to work with them, too, as that tech provider. So that will absolutely become our just more of our focus, going forward. Acquisitions will always be part of our strategy, but they're more difficult to do now. I think M&A activity will be far less in the next 1 to 2 years, because it's just the practicality of how you would conduct due diligence and those type of things is really impacted by travel. So we're keeping, I would call it, a watching brief, on the acquisition front, but really continuing to invest, heavily in our product side and our sales capability to take advantage of this opportunity, because I think it's probably not once in a lifetime. I think that would be overstating it, but when the demand is there, we've got to be ramping up to win new business and kind of support that business as it grows. The part of our business on the shopping mall space, it will recover just as it recovers, and there's not much we can do to influence that. So malls in certain countries will open as they open, right? And that every property owner will make that decision. traffic levels will be what they'll be. Some might get back to 90% volume, some might be 70. One of our customers in the UK was put into administration last week. That could happen as well. So that will, in our view, that's not something that we can necessarily control. So we're focusing on all of the fintech and digital business, and then as the malls business recovers, that'll just be additive to the overall business in the coming years, as opposed to being the mainstay of the business, which it would have been 12 months ago.
Great, Tom. Thanks. That was a really interesting overview. We look forward to getting a further update on the business when you report your annual results next month.
Fantastic. Yeah, we report in August, so that will be that'll be the next kind of communication with the with the market.